You know that feeling? It's late, maybe a Tuesday or a Wednesday, and you're just sprawled out on the couch, half watching something you've already seen 100 times just to have some noise in the background. You get that notification buzz, ding, and you lazily pick up your phone to see what it is. It's your bank. Your available balances, and you see the number. And for the first time in a long time, maybe ever, that number doesn't just look like a series of digits delaying your next bill payment. It actually looks like a cushion. It's $30,000. Maybe it took you 3 years of grinding side hustles. Maybe you inherited a chunk of it, or maybe you just finally got serious about not spending every dime you earn on takeout and subscriptions you don't use. And in that moment, you feel this weird mix of pride and anxiety? Because, honestly, having $30,000 sitting in a checking or savings account feels like a secret power. You walk outside the next day and you look at people differently. You think, if my car breaks down right now, I don't have to panic. If I lose my job, I can eat for 6 months. Feels like safety. Feels like you finally won a round against the system. But here's the thing that nobody really talks about, the thing that sort of sits in the back of your mind like a quiet hum. While you're looking at that number feeling like a dragon sitting on a pile of gold, the bank is looking at that same number and feeling a different kind of vibe. It's not fear exactly, but it's a heightened state of alertness. Because $30,000 isn't just money anymore. To them it's a signal. It's a line in the sand. My name is Jack, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others stay stuck in the same financial patterns for decades. I've been obsessed with this stuff for years, trying to figure out why the relationship between us and our banks is so complicated. And why hitting a number like 30 grand changes the rules of the game entirely. Because here's the shift we're going to explore today: when you have $50 or $500, the bank ignores you. You're just a data point. But when you cross that threshold, when you have $30,000 saved up, you become a variable. You become a flight risk. You become a target. And the way they treat you, the products they push on you, and even the way you view yourself, it all starts to twist. And if you don't understand why that number makes them nervous, and why it should probably make you a little nervous too, you might end up watching that safety net slowly erode without even realizing it's happening. So let's dig in. Let's talk about the secret life of a $30,000 savings account. First, we need to talk about why $30,000 is such a weird, specific psychological tipping point. It's not $1 million, right? You're not buying a yacht. You're probably not even buying a house with that in most major cities. But it is enough money to make you feel dangerous. I call this the Goldilocks zone of complacency. It's that perfect amount of money where you feel rich enough to relax, but you're actually poor enough to be easily hurt. Think about it. If you have $500 in the bank, you're stressed. You know you're one flat tire away from disaster. That stress keeps you sharp. It makes you check your balances. It makes you hesitant to buy that extra round of drinks. It makes you question fees. You're engaged with your money because you have to be. But $30,000? That's a different beast. That's a full emergency fund for a lot of people. That's a couple of paid-off cars. That's a wedding or a decent down payment on a starter home in some places. When you hit that number, the fear evaporates. You breathe this sigh of relief that feels so good you don't want to disturb it. And the bank knows this. They know the psychology of the comfortable saver. They have teams of people whose entire job is to analyze data on people like you and me. They know that once a customer hits a certain balance threshold, their activity levels change. You stop checking the app every day. You start auto-paying everything. You stop looking at the interest rate because, hey, it's just a fraction of a percent, right? Who cares about pennies when you have 30 grand? But that's exactly where they want you. Because your complacency is their profit margin. See, when you were broke and stressed, you were a high-maintenance customer. You called customer service when a $3 fee hit. You moved money around to avoid overdrafts. You were annoying to them. Now, you're just a silent engine generating liquidity. I remember talking to a friend of mine, let's call him Dave. Dave finally hit the $30,000 mark last year. He was so proud. He told me, Jack, I don't even have to look at my checking account anymore. I just know it's fine. And that sounded great to him. It sounded like freedom. But when he said that, all I could hear was the sound of a bank executive laughing in a boardroom somewhere. Because when you stop looking, they start taking. Not by stealing, but by slowly, quietly letting inflation eat your purchasing power while they lend your money out for 10 times the interest they're paying you. So, the first reason they get nervous, or perhaps the first reason they get excited, is that they've finally captured you. They've turned a stressed, active observer into a passive, complacent asset. And $30,000 is the ransom price for your peace of mind. But let's flip the coin for a second. Let's talk about why they're actually nervous. There's a concept in banking called a flight risk. Usually, this refers to wealthy people moving millions to tax havens or competitor banks. But banks are surprisingly sensitive about the $30,000 to $100,000 tier. Why? Because this is the tier where people actually wake up. Here's what happens. You have $30,000. You're feeling good. But then, maybe you read an article or you watch a video like this one, or you get a coffee with that one annoying friend who works in finance. And that friend says, wait, you're keeping $30,000 in a standard savings account? You're getting 0.01% interest? Inflation is 4% or 5% or whatever it is this week. You're literally paying the bank to hold your money. And it hits you. You realize that your safety net is actually a melting ice cube. Suddenly you're not complacent anymore. You're dangerous. Because $30,000 is a big enough chunk to move. It's worth your time to open a high-yield savings account. It's worth the effort to set up a brokerage account and buy an index fund. It's enough to buy a certificate of deposit, CD, that locks your money away from them for a year. Banks hate this. They hate when capital leaves their building. See, banks operate on a fractional reserve system. I won't get too deep into the weeds and bore you with the math, but basically when you deposit $100, the bank keeps a tiny fraction of it and lends the rest out. They are using your money to make mortgages, car loans, and business loans. They keep the profit from the interest they charge and they give you, well, basically nothing. Every dollar you move out of their low-interest bucket and into an investment bucket is a dollar they can't lend out. It's a lever they can't pull. When you have $30,000, you are now a credible threat to their liquidity model. If you, and let's say 10,000 other people just like you, wake up on a Tuesday morning and decide, you know what? I'm moving this to a credit union or an online bank that pays 4%, the bank feels it. It creates a liquidity crunch for them. So what do? They get proactive. You've probably seen this. You hit a certain balance and suddenly your relationship manager is calling you. Or you get an email, congratulations. You're now a silver, gold, platinum member. They offer you perks. Free checks. Waived ATM fees. A nicer color on your debit card. It sounds generous, doesn't it? Feels like they're rewarding you for being a good saver. Honestly, it's kind of hilarious when you think about it. They're giving you perks worth maybe $20 a year to stop you from moving $30,000 to a place that would pay you hundreds or thousands of dollars in interest. It's a distraction. It's a shiny object. I had this happen to me a few years ago. I bumped my savings up to consolidate some funds, and within a week I got a call from a personal banker at my traditional big bank. She was lovely, very friendly, asking about my goals. And then she pivoted. She said, you know, with this balance you qualify for our premium money market account. It has a tiered interest rate. I got excited. I thought, finally, free money. I looked at the fine print. It was 0.05% for the first 10,000, and then 0.1% for anything over that. I was earning more in my standard online checking account at the time. I laughed while I was on the phone. I couldn't help it. She wasn't trying to make me rich, she was trying to make me stay. She was trying to stop me from being a flight risk. So, if you have $30,000 sitting around, watch out for the VIP treatment. It's usually just a velvet rope designed to keep you in the room where the champagne is flat. Let's move on to something a bit more insidious. The third reason banks get nervous, or maybe the reason they pray you stay nervous, is because of how they make their real money. We think banks make money by lending. And they do. But in the modern era, a massive chunk of their revenue comes from fees. Overdraft fees, maintenance fees, wire transfer fees, minimum balance fees. Now, if you have $30,000, you're probably not paying overdraft fees. You're too smart for that. You've got the buffer. But you are the prime target for something else, the inactivity fee or the low balance fee on checking accounts, or the sneaky annual fees on credit cards they upsell you. Wait, why would they charge a low balance fee if you have 30 grand? Because of segregation. Smart people with $30,000 don't keep it all in one bucket. You might have $5,000 in checking for monthly bills and $25,000 in savings. The checking account is where the action is. If your checking account dips below $1,500 for 3 days because you paid rent early, bam, fee. But the real psychological trick here is the credit card. Banks know that $30,000 in savings makes you feel secure. And security makes you spend more freely. It's a paradox, right? You'd think having money makes you stingy. But often, it makes you looser because you know you can cover it. This is where the nervousness comes in for them. They want you to spend. They want you to keep that money flowing out so they can charge interest on the credit side while paying you nothing on the savings side. They are terrified of the person who has $30,000 and stops spending. The person who pays off their credit card in full every month, buys a used car for cash, and refuses to take the personal loan for the kitchen renovation. That person is a bank's worst nightmare. You are using their infrastructure, their vaults, their apps, their fraud protection, but you're refusing to pay the interest tax. So, when you hit that $30,000 mark, you'll notice the marketing shifts. It becomes less about saving and more about unlocking the value of your home equity or financing your dream vacation. They aren't marketing to your saver, they're marketing to your consumer. They are trying to break that discipline. I see this all the time with people who finally get a decent nest egg. They feel rich. The bank confirms this feeling by pre-approving them for a $50,000 car loan. You deserve it, the letter says. You've worked hard. And what happens? That $30,000 savings account slowly dwindles as the monthly payments on the new car and the new furniture chip away at it. 2 years later, the savings are gone, the car is worth less than you owe on it, and the bank? The bank is collecting interest from you on two fronts. The $30,000 wasn't a pile of gold to them. It was a qualification letter for a debt trap. Okay, let's talk about the fourth point, and this one is tricky. This is the one that confuses a lot of people. When you have $30,000, the traditional banks start to realize that if they don't offer you something a bit better than a savings account, you will leave. They know the internet exists. They know you can Google best interest rates and find accounts offering 4%, 5%, sometimes more. So they pivot. They stop trying to trap you in a savings account and they try to move you into their investment products. This is where the line between bank and financial advisor gets blurry, and you need to be incredibly careful. You walk into a branch. You sit down with the nice person who gave you the free coffee. They look at your $30,000 and they say, "You're losing money to inflation. We need to put this to work." And they're right. You are losing money to inflation. That part is true. But then they pull out the brochures. They show you the bank's mutual funds. They show you their relationship with specific insurance companies. They show you annuities or managed portfolios with a 1.5% annual fee. Here is the dirty little secret. Banks are terrible investment houses for the average person. I know that sounds harsh, but think about it. If you go to a bank, you are buying their products. You're not buying the best product on the market, you're buying the thing they make the most commission on. If you have $30,000 and you move it into a bank-managed fund with a high expense ratio and a front-end load, which is just a fancy word for a fee you pay just to buy the thing, you are starting your investment race with a 50-pound backpack on. Why do they do this? Because they're nervous that you'll take that money to a Vanguard or a Fidelity or a Schwab, companies that are built for investing, and buy a low-cost index fund and leave the bank out of the loop entirely. They lose the custodianship of your assets. They want to be the middleman. They want to clip the coupon on your wealth management forever. And here's the heartbreaking part of this story. I've seen so many people, older people mostly, but also young people just starting out, who trusted their bank because they've been banking there since they were a teenager. They have $30,000, maybe $50,000, and they hand it over to the guy at the bank. And 10 years later, they have $45,000 because the fees ate the growth and the market was flat. If that person had just bought a simple S&P 500 index fund and forgotten about it, they'd likely have double that. The bank is nervous because they know $30,000 is the entry ticket to the real financial system. They are fighting to keep you inside their gated community where the prices are high and the returns are low, instead of letting you wander out into the broader market where the costs are low and the potential is high. So, when they pitch you on their exclusive investment opportunities, just remember they aren't doing it out of the goodness of their hearts. They're doing it to keep your assets on their balance sheet so they can charge you for the privilege of losing your purchasing power more slowly than a savings account would. I want to take a little detour here and just talk about us. About you and me. Because while the bank is playing these games, we're playing games with ourselves. Having $30,000 saved changes your brain chemistry. It really does. I've experienced it, and if you have that kind of money, you probably have too. It gives you a sense of invincibility that is totally unearned. I remember when I first crossed a major savings threshold. It wasn't 30, it was a bit less, but it felt like $1 million. I was walking through a store, I think it was an electronics store, and I saw a laptop I didn't need. It was a beautiful machine, fast, shiny, way too powerful for writing scripts and browsing Reddit. In the past, I would have had to do the mental math. Okay, if I buy this, I can't go out to dinner for 3 weeks. I would have talked myself out of it. But with that savings number in my head, the mental math changed. It wasn't about the trade-off anymore. It was, I have the money. I can afford this. It's only a tiny fraction of my safety net. I bought it. And I felt great for about 3 days. This is the safety net trap. The bank loves this. They love it when you view your savings as a pool of available funds for lifestyle upgrades rather than a fortress against disaster. They encourage this mindset with credit cards tied to your account, skip-a-payment options on loans, and apps that let you withdraw from your savings with a single click. When you have $30,000, the banks get nervous you'll leave them, but they also get excited that you might start spending. They know that people with liquidity spend more money. They buy nicer cars. They shop at better grocery stores. They tip more. It's called the wealth effect. The irony is painful. You work hard to build a wall around your life to keep the stress out. But the thicker the wall gets, the more you want to decorate the inside of it. If you want to win this game, and by win I mean actually build wealth, not just look like you have wealth, you have to separate the idea of what I can spend from what I have. The bank sees them as the same thing. Your available balance is just fuel for their engine. You have to see them as separate. The $30,000 isn't for the laptop. It isn't for the vacation. It isn't for the down payment on a depreciating asset. It's for the day the world goes sideways. And if you truly adopt that mindset, the bank will be terrified of you. Because you become untouchable. You become a person who uses their services for free, using the credit card for points and paying it off, using the checking account for liquidity but keeping the minimum in it, and moving your real wealth to places they can't touch. Let me share a quick story about something I did recently that illustrates the final point I want to make. I had a chunk of change sitting in a brick-and-mortar bank. It was doing nothing. Literally nothing. I was getting a statement every month that said interest earned 3 cents. It drove me crazy. So I started looking around. And honestly, it's overwhelming, right? There are robo-advisors, crypto, real estate crowdfunding, high-yield savings accounts from banks you've never heard of that don't have physical branches. It feels risky to move your $30,000 out of the big stone building with the logo and the guards and into an app on your phone. That's the trust barrier the banks rely on. They own the buildings, they must be safe. But I did it. I moved a significant portion of my savings to an online high-yield account. The process took about 15 minutes. I had to upload my driver's license, link the account, verify a couple of small deposits. 2 weeks later, I got my first interest payment from the new account. It wasn't 3 cents. It was enough to pay for my lunch. And that's when it hit me. The big bank wasn't protecting me. They were exploiting my laziness. The alternative economy, the online banks, the credit unions, the investment platforms, they are hungry. They don't have the overhead of the marble floors and the branch managers on every corner. They can afford to pay you 4% or 5% because they want your $30,000. They're not nervous about you, they're desperate for you. And that is the power dynamic shift that matters. When you have $30,000, you are no longer a peasant in the financial kingdom. You are a merchant. You have goods to sell, specifically your capital. If you walk into a grocery store and they try to sell you a rotten apple for $5, you walk out. You go to the next store. You would never tolerate a bad deal on your groceries. But we tolerate bad deals on our life savings every single day because we're used to it. Because the bank has the nice logo in the building. The moment you realize that $30,000 makes you a customer with options, the entire game changes. The banks know this. That's why they get nervous. They know that if you ever wake up and realize that the emperor has no clothes, that their 0.01% interest is a joke, you're gone. And once you leave, you never really go back. You realize that money doesn't care where it sleeps. It only cares about how hard it works. So where does this leave us? We started with that notification buzz. That feeling of seeing $30,000 and thinking, I made it. And I don't want to take away from that. Honestly, hitting that number is a massive achievement. Most people never get there. It represents discipline, sacrifice, and planning. You should be proud of that. But the moment you get there, the relationship changes. The bank stops seeing you as a depositor and starts seeing you as a resource to be mined, or a flight risk to be contained. They will try to soothe you with premium status, scare you with the complexity of the outside world, or distract you with credit card perks that cost you more in the long run. They are nervous because $30,000 is the tipping point. It's the amount of money where the math starts to matter. It's the amount where inflation hurts, where fees become insulting, and where the opportunity cost of doing nothing becomes a genuine tragedy. Your job is to keep your wits about you. Don't let the comfort of that balance fool you into complacency. Don't let the VIP treatment stop you from asking hard questions about fees and interest rates. And definitely don't let them talk you into high-fee investment products just to keep you in the family. Take that $30,000. Respect the work it took to get it. Treat it like the business asset it is. Shop around. Negotiate. Move it if you have to. Because at the end of the day, the bank isn't a friend. It's a business, and you are the supplier. And the moment you start acting like a partner rather than a passive participant, you stop being a customer and you start being an owner of your own financial life. It's a scary thought, maybe. It's easier to just leave it there and ignore it. I get it. We all have enough stress in our lives without managing our own hedge fund. But honestly, There is no better feeling than looking at that bank balance and knowing that you are the one in the driver's seat, not them. You've done the hard part. You saved the money. Now just make sure it's working as hard for you as you did for it. Thanks for hanging out with me and listening to my ramblings about money and psychology. I know this stuff can be dense, but it matters. Go check your rates, look at your fees, and maybe, just maybe, make them a little nervous.